What if the person doing absolutely nothing with their investments is beating you? Not sometimes. Not in certain markets. Every single time. Over every single decade. In recorded financial history. What if the secret to building $500,000 is not working harder, not researching more, not picking better stocks, but doing significantly less? Here is what you are about to discover. Why the investor who checks their portfolio twice a year consistently beats the investor who checks it daily. The exact math showing how $200 per month becomes $500,000 without a single stock pick. The precise account stack that legally saves you $80,000 to $130,000 in taxes over your investing lifetime. The 5 wealth traps that silently destroy compounding before it ever starts. And the one automation setup that takes 10 minutes and runs for 40 years without you touching it again. Stay with me, because everything you think you know about investing is about to be questioned. My name is Zishan, and welcome to the Wealth Operating System, where we treat personal finance like an engineering problem. Let us install the simplest wealth building system that exists. Chapter 1. The question that changes everything. Let me ask you something directly. How much time do you spend thinking about your investments every week? An hour? 2 hours? More? Reading market news, watching finance videos, checking your portfolio on your phone during lunch to pause, researching the next hot stock, wondering if now is the right time to buy, or whether you should wait for a dip. Now here is the uncomfortable question. What if all of that, every single hour, is making your financial future worse? Not the same, worse. Here is what the data actually shows. The S&P Dow Jones Indices Group, an independent research body, publishes a report every year called SPIVA, S&P Indices versus Active. They track how professional fund managers, people with Bloomberg terminals, teams of analysts, Ivy League degrees, Manhattan office spaces, and access to more financial data than you will ever see, perform against a simple index fund that just buys everything and never trades. Over any 10-year period, 85% of professional fund managers underperform the index. Over any 20-year period, 94.1% underperform. 94 out of every 100 professional investors with every advantage imaginable lose to a fund that does nothing. A fund that cannot read the news, cannot panic, cannot make decisions, just buys everything, holds everything, and compounds year after year after year. If the professionals cannot beat doing nothing, what makes you think you can? And more importantly, why are you even trying? Chapter 2. The math that makes this real. Let me show you exactly what doing nothing actually produces in real numbers, year by year. The S&P 500, which tracks the 500 largest publicly traded companies in the USA, has returned an average of approximately 10% per year over the last 100 years. Through world wars, through the Great Depression, through the 2008 crash, through COVID, through every recession, every political crisis, every moment the financial media declared the end of capitalism as we know it. 10% average. Every decade, without exception. Now, let me show you what that means for your money. You invest $200 per month. That is it. $200. Less than most people spend on food delivery in a single month. At 10% annual return, year 5, $15,500. Not impressive yet, but the engine is running. Year 10, $41,000. Starting to look real. Your total contributions were $24,000. The market added $17,000. Year 15, $84,000. The market is now contributing more than you are. Year 20, $153,000. You contributed $48,000. The market added $105,000. More than double your contributions added automatically while you slept. Year 25, $265,000. The compounding curve is now steep. Year 30, $452,000. $452,000. From $200 per month, you contributed $72,000 total over 30 years. The market added $380,000. More than 5 times your total contributions. Added automatically, without a single stock pick, without a single market timing decision, without a single hour of research. Now pushed to $300 per month, year 3 becomes $678,000. At $400 per month, year 3 becomes $905,000. At $500 per month, year 3 becomes over $1,130,000. $1,130,000. From $500 per month. No stock picks, no market timing, no luck. Just time, consistency, and a fund that costs 0.03% per year.
Chapter 3. Why almost nobody pulls this off. Here is the question that nobody asks clearly enough. If the math is this simple, this documented, this undeniable, why does the average American household approaching retirement have a median 401k balance of just $71,000? Not $452,000, $71,000. Why is the math not working for most people? 2 reasons, and both of them are completely fixable. Reason 1, they never understand what an index fund is, so they never use one. They keep their money in a savings account, earning 3% to 4%. They pick individual stocks based on news headlines, or a tip from a colleague, or a chart they saw on social media. They pay a financial advisor 1% to 1.5% per year to do something complicated that statistically underperforms the index 94% of the time. Reason 2, they panic at exactly the wrong moment. They invest for a few years. The market drops 30%. Their $80,000 becomes $56,000. They sell. They move to cash. They wait until the market recovers. And by the time they feel safe enough to invest again, the market has already recaptured all the losses, plus added another 20% on top. They sold at the bottom. They bought back near the top. Studies of investor behavior during the 2008 crash showed that people who sold during the downturn earned dramatically lower returns than people who did nothing. People who did nothing won. This is not a coincidence. This is human psychology working against you at the exact moment your financial future depends on you doing nothing. And the solution is surprisingly simple. Chapter 4. The right engine. Before we talk about what to do, you need to understand what you are actually buying. An index fund is a basket. That is the entire concept. Instead of trying to pick the next winning stock, you buy one fund that holds a tiny piece of every large company simultaneously. The Vanguard S&P 500 ETF, ticker VOO, holds shares of the 500 largest U.S. companies. Apple, Microsoft, Amazon, Nvidia, Alphabet, Berkshire, all of them, at once, in one fund. When Apple goes up, your fund goes up. When some random company collapses to zero, your fund barely notices, because that company was less than 0.1% of the basket. You own the whole field, so you cannot lose to the field. The Vanguard Total Stock Market ETF, ticker VTI, holds over 3,000 US companies. Even broader, even more diversified. Both cost 0.03% per year. For every $10,000 you have invested, you pay $3 per year in fees. $3. Now, compare that to the actively managed mutual fund charging 1% per year. Same $10,000. $100 per year in fees. That difference, 1% versus 0.03%, on $200,000 invested over 20 years, costs you approximately $44,000 in lost wealth. Not because the active fund did worse, but simply because of the fee. And statistically, the active fund did do worse. You paid more for less. Warren Buffett, the greatest investor of our generation, instructed the trustees of his estate to put 90% of the cash he leaves his wife into a single low-cost S&P 500 index fund and leave it alone forever. The richest investor alive recommends the laziest strategy. That should tell you everything.
Chapter 5, the account stack that saves you $80,000. Buying the right fund is only half the equation. Buying it inside the right account is where most people leave $80,000 to $130,000 on the table, completely unnecessarily. Here is the exact account stack in the correct order for USA, UK, and Europe. If you are in the USA, account 1, your 401k, up to the employer match. If your employer matches 4% of your contributions, you contribute 4%. That is a 100% immediate return on your money. Nothing else in personal finance comes close. The 2026 contribution limit is $24,500 for workers under 50. Skipping the match is the financial equivalent of finding $100 bills on your driveway and walking past them every morning. Account 2, Roth IRA. You contribute after-tax dollars. Your money grows completely tax-free. You withdraw completely tax-free in retirement. The 2026 contribution limit, $7,500 per year. Income limit for full contribution, $153,000 for single filers, $242,000 for married couples. Over 30 years, the tax-free growth of a Roth IRA versus a taxable account is worth approximately $60,000 to $90,000 in additional wealth on exactly the same investments. Account 3, HSA, if you qualify. The only account in the U.S. tax code with 3 layers of tax benefits. Contributions, pre-tax. Growth, tax-free. Withdrawals for medical, tax-free. After 65, withdraw for anything, like a traditional IRA. 2026 limit, $4,400 individual. $8,750 family. Most people use their HSA like a medical debit card. The wealthy invest every dollar, pay medical expenses from their regular income, and let the HSA compound for 30 years. Account 4, taxable brokerage. After everything above, anything left over goes here. No limits, no rules, full flexibility. If you are in the UK, step 1, workplace pension up to full employer match. Free money first, always. Step 2, stocks and shares ISA. £20,000 annual allowance. Completely tax-free growth. Completely tax-free withdrawals. No capital gains tax, no income tax on dividends. The ISA is the most powerful wealth-building account available to UK investors. And most people use it for cash, earning 4%. Invest it. VWRL or VUSA. Vanguard's All-World or S&P 500 ETF. Inside your ISA. Zero tax forever. If you are in Europe, maximize any workplace pension match first. Then invest through a low-cost brokerage, trading 212, DeGiro, or local equivalent. Vanguard FTSE All-World UCITS ETF. Globally diversified, low-cost, available across every European market. The order of operations is everything. Fill the tax-advantaged accounts first, before a single euro, pound, or dollar goes into a taxable account. Chapter 6, the 5 wealth traps. Now, the most important chapter in this video, because everything you just learned, the math, the fund, the account stack, means absolutely nothing if these 5 traps are active in your life. Trap 1, the car payment. The average car payment in the USA in 2026 is approximately $735 per month. $735 per month invested instead at 10% annual return over 30 years is $1,660,000. $1,660,000 lost to a depreciating asset that loses 20% of its value the moment you drive it off the lot. Trap 2, lifestyle inflation. Every raise you receive automatically absorbed by a nicer apartment, better restaurants, upgraded subscriptions. Your income grows. Your savings rate stays identical. Your wealth never accelerates. The fix? Automate 50% of every raise directly to investments before you see it. Trap 3, high interest debt. You cannot outinvest credit card debt at 24% interest. The market returns 10%. Your credit card charges 24%. You are losing 14% every single month you carry a balance.
Pay off high-interest debt before investing, except for the 401k employer match. Trap 4. Checking your portfolio daily. Research shows investors who check their portfolio daily make more emotional decisions, earn lower returns, and accumulate less wealth than investors who check once per quarter. Move the brokerage app to a folder you never open. Check once per year. The accounts that earn the most are the ones nobody touches. Trap 5. Waiting for the perfect moment. There is no perfect moment. There never was. There never will be. The market is always either too high or too scary to feel like the right time to invest. The data is clear. Time in the market always beats timing the market. Every year you wait costs you far more than any market timing strategy could ever save.
Chapter 7. The 10-minute setup. Now, the only part that actually matters. What you do in the next 10 minutes to install this system into your life. Step 1. Open the account. In the USA, go to fidelity.com, vanguard.com, or schwab.com. Open a Roth IRA. 10 minutes. Social security number, bank account details, done. In the UK, open a stocks and shares ISA through Vanguard UK or any regulated platform. In Europe, open a brokerage account through Trading 212 or DeGiro. Step 2. Choose your fund. USA, VOO or VTI. UK, VWRL or VUSA. Europe, Vanguard FTSE All-World UCITS ETF. One fund. That is all you need. Step 3. Set up the automatic transfer. Pick the day, pick the amount. Any amount. $100, $200, $500. Set it to fire on the same day as your payday, before you see the money, before you can spend it. Confirm. Done. Step 4. Move the app. Take your brokerage app, move it to a folder on the third screen of your phone. Name the folder something boring. Never open it except once per year. To confirm, everything is still running. Step 5. Increase contributions annually. Every time your income increases, increase your monthly contribution by 50% of the raise. Just 50%. Keep the other 50% for your lifestyle. Over 10 years, this single habit adds approximately $80,000 to $150,000 to your final portfolio without any additional sacrifice. That is the entire setup. 10 minutes, running for 40 years, building wealth while you sleep, while you work, while you live your life completely automatically. Here is the question I want you to sit with after this video ends. Are you working harder than necessary on the part of investing that matters least? Stock research, market timing, portfolio rebalancing, while completely ignoring the part that matters most, getting money in, automatically, consistently, into a low-cost index fund, inside the right account, and never touching it. Because that is the answer to the question this video opened with. The person doing nothing is beating you, not because they are smarter, not because they got lucky, because they set up a system once and had the discipline to never interrupt it. You now have the exact same system. The fund, the account, the automation, the order of operations, the 5 traps to avoid. The only variable left is whether you set it up today or spend another year waiting for the perfect moment that will never arrive. Now, one question before you go. What is stopping you from setting this up in the next 10 minutes? Drop your answer in the comments, because your answer tells me exactly what content to build next to remove whatever is standing between you and this system. And if this video answered a question you did not even know you had, subscribe, because every single week we are cutting through the noise and showing you exactly what actually moves the needle for young professionals in the USA, UK, and Europe who are serious about building real, lasting wealth. My name is Zishan. This has been the Wealth Operating System, and I will see you in the next upgrade.